quickly, I will introduce Aseli and I will go through our journey around technical assistance and sort of, highlights of what we've learned. So, Aseli, we describe ourselves as a market catalyst and we exist to create a more competitive and inclusive market for agri-SME financing. And we do this by across, through certain levels. One is financial incentives for lenders that address two key market barriers. That is the risk and cost of lending to agri-SMEs. We also provide TA to both lenders and SMEs. We also generate data and learning for our internal purposes, but then also for the wider ecosystem to advance, the level of knowledge around agri-SME financing, but then also lastly, to influence policies related to agri-financing. And we operate across 5 countries, Kenya, Uganda, Rwanda, Tanzania, and Zambia. And we've been in existence since 2020, and we just celebrated 5 years of operation and impact within the agri-SME financing space. So I won't spend too much time on this slide. I think this has been exhaustively covered in terms of the dependence on donors for financing technical assistance. We think this won't change significantly anytime soon. We believe donors will continue to be the primary funders of technical assistance. However, in our paper, we make a case for gradual participation from other stakeholders, and I'll go into a bit more detail on that shortly. Again, this has already been covered in terms of the focus on outputs, in terms of number of SMEs trained, etc., rather than outcomes in relation to accessing finance and other outcomes as well. This is also somewhat been covered in terms of misaligned incentives across donors, tier providers, and the SMEs, as well as the low SME willingness to pay. It was interesting hearing Kate's example on the SME cohort and the willingness to pay. In our brief, we talk about our experience as well in testing willingness to pay amongst SMEs. And for us, it was similar to Kate's experience. There was varying willingness to pay, and oftentimes it's difficult to scale payment by SMEs if you're running a large program that's possibly multi-country. I mean, oftentimes they'll ask for a payment plan, etc., and we just found it really difficult to implement. So curious to learn from others who've implemented cost share models at scale. So we've been running the TA program, since we launched, and it has gone through iteration since then. Initially, the same model which has been run by other BDS providers in terms of you provide BDS to the agri-SMEs, and then you try and make them to our lending partners, and with limited success in terms of financing outcomes. And so over time, we have engaged more with our lending partners just to really start from the supply side in terms of understanding what their needs are, what the priorities are in terms of value chains, in terms of SME targeting, etc., and design TA interventions around specific lender priorities. So, this slide highlights the model and the approach in terms of beginning with the lender, them being able to articulate the target segments. And we've also been able to overlay this with the data that we've built over the years through supporting 5,000 plus transactions and understanding the profiles of businesses that lenders are actually lending to, where the biggest gap is, etc., and focusing our TA interventions to the segments where we believe there's a higher return on investment in terms of financing outcomes. And then also honing in on, just being clear on the outcomes or rather developing shared outcomes between the lender, Aseli, the BDS provider, in terms of what you want to achieve from the TA program. So we ran our first sort of lender-focused cohort with Family Bank last year, and the results were, promising in terms of SMEs that are able to achieve compliant loan documentation, 95% from a baseline of 0. Just shortly after the program, about $360,000 in financing was achieved. And then there's a larger pipeline that's still under review. As we can appreciate, these outcomes take time to materialize. And sort of the key insight for us is that there's lots of good tea in the market and good BDS providers. But oftentimes the approach of starting from the demand side and then trying to link to the supply side is ineffective in terms of unlocking finance. And so when good TA or good BDS providers are then linked with the supply side and working in concert with each other, then we see more impactful outcomes being achieved. One of the things that's important to highlight and a key differentiator for us at Aseli is that we are providing incentives to these lenders to lend to these riskier, harder to serve segments. And oftentimes we get feedback from the lenders that in the absence of the incentives that you're offering, even these SMEs whom have complete documentation, have gone to the BDS, they would not ordinarily get financing simply because of the risk profile of that business. And so one of our key learnings for us is that the financial incentives have created a pool for TA. So because the lenders are increasingly incentivized to reach these hard to serve segments, and are getting the portfolio guarantee, they're getting cash-based incentives, then they're more motivated and they're more capacitated to reach these SMEs. And even the credit officer that was referenced earlier then will look at this loan application sort of from a different lens. So the incentives, are supporting the lenders in growing their portfolios, in taking on more risk and to lending to SMEs that they would not otherwise serve. The TA is supporting them to and the lenders are increasingly participating in the TA program. SMEs are becoming more credit ready and the portfolios are growing. So we are seeing this sort of positively reinforcing cycle that's being achieved purely, well, not purely, but mostly on the account of the incentives that we're offering to these lenders. So in the interest of time, I'll just quickly go to, so one of the things I just want to highlight before I conclude is that we're starting to see lenders also being interested in sharing the cost of the TA. So even as we're talking about the donor funding for the TA going down over time, we're also talking about SMEs taking on a larger share of the cost of TA. We don't expect the SMEs to share the cost of the TA at the same rate at which the donor funding is going down. And so we think that other actors such as lenders or investors can come in and sort of start to plug that gap in terms of investing in the TA. And so that's a model that we're starting to test with our lending partners, where they would share in the cost of delivering a TA program. And that's something that we plan to scale up in the coming years. So the questions for us that I'm putting forward is, can TA be institutionalized through lenders as the OD environment tightens? How can we build SME willingness to pay while maintaining reach to underserved segments? And lastly, what's the right role for public subsidy versus commercial cost sharing in a hybrid model? So those are the questions I leave the audience with.